The administration keeps its economic agenda alive. The inflation debate continues, and earnings, well, they just keep chugging along. This is Bloomberg Wall Street Week. I'm David Westin. This week, special contributor Larry Summers on his inflation debate with Treasury Secretary Yellen.
I have enormous respect for Secretary Yellen, and I see a variety of things suggesting that inflation may accelerate.
And Nuveen CEO Jose Minaya on his way of hedging against inflation in case Larry just might be right.
I always say it's one of the best investment theses I've come across because it's as simple as people need to eat.
We had another week consumed with negotiations back and forth over President Biden's economic agenda, all within the Democratic Party, with President Biden announcing a framework just as he got out of town for his trip to Europe for the G20 and the COP26 summits.
These plans are fiscally responsible. They are fully paid for. They don't add a single penny to the deficit.
And whatever ultimately gets passed into law for infrastructure and Build Back Better, this week continued the debate over inflation, with two of those who should know best directly taking one another on, when Treasury Secretary Janet Yellen disagreed on CNN with what Larry Summers had said right here on Wall Street Week about the problem of inflation.
We are going through a period of inflation that's higher than Americans have seen in a long time, and it's something that's obviously a concern and worrying them, but we haven't lost control.
And Larry came right back at Janet Yellen on Twitter, saying until the Fed and Treasury fully recognize the inflation reality, they are unlikely to deal with it successfully. But for all the talk of more fiscal stimulus and inflation, the week on Global Wall Street was really given over to earnings, particularly those from big tech. Here's Apple's Tim Cook.
We are optimistic about the future, especially as we see strong demand for our new products.
And also from the auto companies. Here's GM's Mary Barra.
We're selling every vehicle we can make, and I think that, along with the overall environment, is what allowed us to have a beat for the quarter.
And when it came to equities, those earnings were enough to pull out a win, with the S&P 500 up 6.9% for the month, making this October the best for the index in 6 years, while the Nasdaq was up 2.4% for the week, and the bond yield curve flattened somewhat, with the short end moving up and the 10-year yield coming down under 1.6 this week. To take us through what the markets had to teach us this week, welcome now Katie Koch, Goldman Sachs co-head of fundamental equity funds, and Kate El-Hillow. She's Russell Investments Chief Investment Officer. Kate, welcome to Wall Street Week. Congratulations on your promotion, by the way. Give us a sense of what you saw in the markets this week. As I say, the equities did really, really well, despite the fact they had a little headwind from a couple of the big tech companies.
Yeah, David, thanks so much for having me. And earnings season are about 50% of the way through, and it's been good. I mean, not great like we saw in Q1 and Q2, but 85% of the companies beating, so it's still above, kind of the average. But I'd say the one big caveat we would flag is around, company guidance. And a lot of that had been focused around a lot of supply chain issues and other, impacts that pricing power initially, for the companies that can do it should be able to work through. But that is something to continue to look out for as we go into Q4. I think for companies that did miss, they have gotten hit reasonably hard. And so while we've seen the market react overall well to earnings, on average 4% down for companies that aren't meeting expectations. And so from our point of view, kind of healthy spread between winners and losers is a really good opportunity for active management and really starting to dig into some of the differentiation that we expect to see going forward.
So, Katie, let's talk about tech for a second, because we had so many big tech earnings out this week. A lot of them positive, but then we had the Amazon and Apple, which really were a hiccup, one of which was really supply chain in the case of Apple. The other was really more labor in the case of Amazon. Did it tell us anything in the longer term about big tech driving this market, which it has done for so long?
I know they did disappoint, but I just to take Apple for a second. People are disappointed, but they should remember iPhone sales were still up 46% year over year. So there still is good growth there, but expectations, of course, were for 53%. I think what you've seen there is very specific to what you just said, and maybe we can unpack it later, which is supply chain issues and also labor. And we don't think that that's going to. We think that's an issue that they can actually get over. Other interesting trends that we're focused on in tech earnings generally would be I could maybe touch on payments as an example and what's happening in the finance space. I'm really interested in the third quarter of this year as being kind of the first quarter that we've seen the potential for how much disruption we think is coming at the financial sector. Just for context, there's $16 trillion of market capitalization in financials compared to, for example, $14 trillion of market capitalization in the internet. And we are on the precipice of seeing major disruption across that whole sector. We saw some big losers get printed in the third quarter. So the merchant acquirer sector, if you look at the earnings of those companies, they disappointed a lot because they're getting disintermediated by companies like Shopify or Toast, for example, that are offering those services, better product, better pricing. And then on the winning side, and I'll end my comments there, but in terms of winners in this space, you would look at buy now, pay later, which, as my husband says to me, isn't that just the same thing as a credit card? What's buy now, pay later? But effectively, what it's great product for the millennial and Gen Z consumer. You basically pay on deferred payments. There's no late fee. And there's actually no interest charged either. And the reason it works is because they charge the merchants a higher fee. And those merchants tolerate that higher fee because they're getting a bigger addressable market and higher volume. Now, of course, we need to go through a credit cycle to see if this is a durable business model, but they're taking tremendous market share from traditional banks.
So, Kate, apply your advocacy of active management in this marketplace. Apply it to tech. How does that work? Where do you look for real opportunities in tech? What do you tend to stay away from?
Yeah, I mean, I think when you're talking about tech too, I think it's important to focus on both public and private markets and just where you're starting to see disruption. I think Katie often will focus on some of the trends and the themes and the structural shifts that we're seeing. And I think that's where, again, active management and really being able to dig into some of the disruptors and the different ways that we're seeing companies be able to change the way that we're operating. Often is being done as much, and I'm sure Katie will combat this a bit in the private markets as much as we're seeing it in the public market. So I would say from a tech perspective, we do try to focus on across kind of everything from VC early stage all the way through to the public markets. And I think that the thing that we all have talked about, it's like now like tech isn't a sector, like it's in every kind of industry in every company. And so really thinking through where some of the big shifts are going to be and where the investment's happening. And that's where I think that active management element of it and really understanding what management teams are doing and getting it right is so critical.
So as an active manager, Katie, I would assume you go company by company, but are there some categories? And let me specifically address one, B2B versus B2C in tech. For example, this week we saw Snap really take a hit because of some privacy changes made by Apple. Do you get a little nervous about possible regulatory problems in the B2C area? That's for Kate.
Oh, sorry. Yeah, in the B2C area, I think a couple things, and from regulatory perspective, and changes that are happening in lots of ways. I think it is healthy, for us to be challenging and thinking through some of the shifts that this type of change in the way that we're operating is impacting how we live day to day. And so while there are challenges that we expect these companies to have to deal with, the fact is that they're going to be around, and the profitability and the growth that we expect from them is going to be there. And maybe you end up getting some more competition that comes out of this, and you get some of the less known mega tech companies get a bit more of an inroads as you see a little bit more regulation and challenges coming through. And so we look at it as healthy kind of progress that in terms of having some of that come into the discussion.
So Katie Koch, one of the things that we've talked about a lot is what's going on in Washington, or not going on in Washington right now, but they have some sort of a framework, whatever that means. And I think a lot of corporations breathed a little bit of a sigh of relief that the tax part of it didn't go farther than they thought it was going to go, right? Do you take that into account with respect to future earnings projections?
Yeah, of course. I mean, we understand that the tax burden, which went down, is going to shift back upwards to support all of the spending that we need to do, some of which is really important in this country to address systemic issues around income inequality, et cetera. And we are able to bake that into the margins of companies. And while we expect to see, some hit from that and also a hit from supply chain resilience, which we'll talk about later, we still see tremendously strong demand and actually a path forward for companies to continue to generate earnings. The one thing I want to comment about markets here is we've had the best October. What was it you said?
6 years.
6 years.
Yeah.
So we got markets up 25% year to date. We've had a lot of strength out of equity markets, and people always ask me what's going to be the catalyst, like what would make things inflect. And I would really point to if we get a troubled earnings season, because that's what's supporting markets at these valuations. And so yes, being able to predict margins and what's the impact on that's really important.
Okay, prediction. Kate El-Hillow, let's go. Last one to you. What about earnings going forward? We've had a really good run on it. What are you looking at in the fourth quarter into 2022?
Yeah, I mean, we do expect a slowdown in the growth that we have been benefiting from, but we're still constructive on the cycle. We think a lot of the supply chain issues will continue into 22, but they're going to start to dissipate, and maybe you'll get a bit of a demand balance out from the consumer, but the consumer is still healthy. Companies are flush with cash, and we're seeing more indicators of companies actually investing. And from that perspective, we feel good about kind of where earnings are, but it's certainly going to taper off from what we saw in kind of the 4 quarters coming out of the crisis. And you're starting to see that with this quarter, but we're still constructive going on to next year and think companies will be able to kind of survive through kind of any inflationary pressures. And we're still much in the transitory camp. So we think that this will temper, but it's still going to be a positive place for equities, and earnings are going to help drive that.
Kate, thank you so much for being with us. That's Kate El-Hillow. She is Russell Investments CIO. Katie Koch of Goldman Sachs will be staying with us as we focus specifically on supply chains and how prominently they have figured this week in those earnings reports. This is Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Westin. If earnings were the big story this week, supply chain difficulties were the constant narrative through all of those reports, as we heard from the CEOs of Raytheon, GM, and Carrier.
We're not immune from the challenges of supply chain. In fact, we talked about this morning on our earnings call. The fact is, we'll probably see almost $300 million of lower revenues this year because we can't get material into our shops and we can't get the labor that we need.
It will linger into next year, and we're right now our feeling is we'll be in a much better shape in the second half of 2022. And we're also taking steps over the medium term to make sure we're never seeing this kind of constraint, not only with chips, but with other, whether it's critical materials or just the overall supply chain, because we have an aggressive growth strategy in front of us, and we're going to make sure that we can execute it. So it's a near-term problem that we'll work through.
Supply demand is really out of whack. You see it in chips. Whenever you have to buy chips from on the brokerage market, it's always going to be painful and expensive. We see it on raw materials, copper price, steel, aluminum. So we're seeing a lot of pressures on raw materials and tier 1, tier 2 pricing, but we're managing it through price increases, and we're having to be very aggressive on things like G&A, having to be very creative on how we manage logistics.
Katie Koch of Goldman Sachs has remained with us so we can talk about supply chains. So I heard about it all week long from CEO after CEO. Tell us about supply chains. Where are we?
So 2 main takeaways, I think, from this earnings season. I've also been speaking to a lot of CEOs. And the first is that it is very clear that unit growth has been constrained by supply chain issues. So we'll talk a lot about tech, but let me talk about something very different from tech. Let's talk about pools. We love pools. We've liked them for a while. They've been big pandemic beneficiaries. Our pool CEOs, the ones building the pools and the ones supplying the pools, believe that unit growth could have been 50% higher without the supply chain issues they're facing. The supply itself and of materials and also the labor, because we're facing a great resignation in this country, and we're currently have the lowest labor force participation rate since World War II. So that's a big problem. So that all goes under unit growth is constrained. And then the second issue, the second thing that I would highlight is something that Mary said I think is really, really important, What she said is that, what I heard her say is that over the longer term, they're going to address this issue because they need to be positioned for growth. And I think what she means by that is that they're going to have to reshore some of this capacity and focus on supply chain resilience. And it is my view that actually Wall Street has probably put too much pressure on companies to optimize their supply chain. And we're going to get a much better balance going forward between that supply chain optimization and the resilience that's become very obvious that we need.
So there are a couple of issues there, I think. One is where do you get the materials from?
Yeah.
We relied upon some countries perhaps too much. We have to diversify on that.
Yeah.
The other is how much inventory we maintain. Just
Yeah.
in time was very popular for a long time,
Yeah.
very efficient for a lot of companies.
Yeah.
Is this going to affect margins going forward? If we make those adjustments to supply chains, it
Yeah.
may cost more money.
It will. And it will impact margins most likely, and we're going to have to kind of get used to that. But of course, we need the top line to come through too. And if people want to sell product, they need to have inventory. So again, it's going to come back to the balance of these two things. I do think there's an incredible investment opportunity, and our team believes there's an incredible investment opportunity in investing in the companies that are going to help reshore some of the manufacturing capacity of the United States of America. And so there I would point to, you heard all those people are dependent on chips. Chips fuel the world. They're fueling the technological advancement that we're seeing across all sectors. And so we can't be dependent on that just from another corner of the world. We're going to have to take some of that manufacturing capacity here. So we love chip manufacturing equipment.
So back when I was running a budget, at Cap Cities and then at Disney,
Yeah.
one of the questions I'd ask every quarter if we were down is this a timing issue or have we permanently lost this revenue for some point? Let me ask you that question about supply chains. When you see it down because of the units, as you described, is that demand waiting for when the supply is there or could we lose some of the demand?
Yeah, so in other words, are people still going to buy pools and iPhones?
Yeah, exactly.
And I believe they will. And they're just going to have to wait a little bit longer. Now, of course, that requires us to have a reasonable economic backdrop, so that with that caveat, but they will. And in the iPhone space, if you had to wait longer, you're not going to switch to another provider. You will go out and buy that iPhone. So in some ways, we know that demand has been kicked into next year. But again, these companies still have to position themselves for the long-term runway of growth, and they will invest in the reshoring of their supply chains.
So, Katie, with just about every CEO I talked to, the supply chain discussion came right up with cost increases.
Yeah.
And inflation. It raises the question, okay, as this lasts well into 2022, which it seems clearly it will, some people say even into late 2022, what possible effect might that have on inflation? Because a lot of the CEOs we've talked to said, we raised prices.
Yeah, absolutely. And so, of course, you want to be with the companies that have the pricing power to pass that through. I'd say three quick things. We are in the camp that these supply chain issues last throughout 2022. There's not an easy fix for them. And there's an investment opportunity on the back of that, which we talked about. The second thing I would say is that the inflation in the labor space is real. You and I have talked a little bit about this before, but we have failed to pass minimum wage in this country for many decades. We've now actually jumped over minimum wage because we've had to bid people back into the labor market. Now, the question that we have to really think about is that been a one-time reset in wages, or are we going to get continued upward pressure? And time will tell on that. But both of those suggest a higher cost structure.
And I wonder whether our wage increases actually are lagging, because if you look at the consumer price index, it is going up faster than the wages are. Wages are going up, but not as fast. Does that mean we're going to have to catch up at some point and we're going to have even more wage increases?
Well, that's how you get inflation, right? But it's very determinant on get that sticky upward pressure of wages going up, which will put, how that cycle works going forward.
But does that affect which companies you want to invest in the sense that some are more sensitive to that wage inflation than others are?
Yeah, so I would say right now we see a very healthy consumer. They're benefiting from higher wages. And we're seeing that come out in the data. If you look at credit card data, just to show you the health of the consumer and why we like the consumer, we have American Express publishes spending trends. Spending is up 36% versus 2019. So we've had a big jump in spending. The other thing I just want to say about consumer in terms of where we're focused, it's the millennial and Gen Z consumer that are driving a lot of that increase because they like experiences over things, and it's safe now to go out and have experiences. And they also have a higher risk tolerance around experiences than baby boomers. Baby boomer spending, according to American Express data, is actually down 6% relative to 2019. So we see health in the consumer that's repaired their balance sheet, has firepower, and we're very much leaning into those consumer companies that have pricing power and can benefit from a healthier consumer.
So out of left field, let me push you too far. Does that take you to the metaverse? And what Facebook did? Because if you're talking about millennials and experienced rather than purchasing, that sounds to me a little bit like the metaverse.
Yeah, so I love that you brought up the metaverse. Obviously, we have one of the largest companies in the U.S. decided to rename themselves this week to Meta, which is Facebook. Not everybody knows what the metaverse is. So very simply put, it's the idea of going from looking at the internet to kind of living on the internet. And for those of you at home who have young children, you probably know the Roblox company that allows you to build these virtual communities. And yes, this is driving consumption online in new ways. And that consumption is going to be maybe funded by cryptocurrency. So it is very much a brave new world. The one thing I will tell you, Facebook's excited about it. They've renamed themselves, obviously, and they spent $10 billion this year against that goal. And that spending is going to go up year after year. They've told everyone that publicly. But if you're worried about living online all the time, I still think it's a long way out until we get to the full metaverse. For now, we're still in real life. And if I had to invest in something right now, it would be the great outdoors over the metaverse, at least in the next couple of years.
The real universe rather than the metaverse.
The real universe, exaczly.
Oh, wow. That's very retro of you. By the way, for those of us with small children, we hope that it's going to take a while, right?
That's true.
Because it's a little scary.
It is a little scary, too.
Okay, thank you so much, Katie. It's always great to have you, particularly in the studio now.
Yeah.
That is Katie Koch.
In real life.
In real life, exactly. We're not in the metaverse, right? We're here together. That's Katie Koch from Goldman Sachs. Coming up, we take a look at the week ahead on Global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Let's take a look at the week ahead on Global Wall Street, starting with Annabelle Drewlers in Hong Kong.
Well, David, we'll be digesting the results of this weekend's election in Japan over the coming days. Over in China, we'll have another pulse check on the depth of the slowdown. Now, a private PMI survey is due Monday, and the annual International Import Expo will be another focus. Now, that starts on Friday over in Shanghai and typically begins with a keynote from President Xi. Plus, we'll have a closely watched rate decision in Australia on Tuesday. This, of course, the latest battleground for market bets that central bankers will need to tighten quicker than planned. To Lauren right now.
Thanks, Annabelle. Well, here in Europe, it's all about COP26. Global leaders will descend on Glasgow with the primary goal of preserving a target no more than 1.5 degrees of global warming. On the agenda, ending coal use. That's in light of an energy crisis within Europe and Asia. How to raise $100 billion for poorer nations and the 2015 Paris pledges. We also have a rate decision from the Bank of England, sticking with financials, earnings from Credit Suisse and Standard Chartered. Taylor.
Thank you, Laura. I'm Taylor Riggs here in New York. I'll take over for some of the U.S. news that we're looking forward to. Of course, big earnings still to come. Uber and Lyft, of course, we know that these are such a gauge for the reopening, mobility, food delivery. But frankly, we have to say the big news all comes from the economic side. First, starting, of course, on Wednesday, going to be that Fed meeting where economists are really looking for the Federal Reserve to announce a taper of those asset purchases. Sticking with economics, the third big piece of news that we're going to be watching on Friday is Jobs Day. We're coming off of a third quarter GDP that was a little weak, but weekly jobless claims that do look strong. The median survey here on the Bloomberg terminal showing about 500,000 jobs to be added. Back to you, David.
Thanks to Annabelle, Laura, and Taylor. Coming up, the inflation hedge you may not have thought much about. The beauty of owning land, especially when it's farmland, with Nuveen CEO Jose Minaya. That's next on Wall Street Week on Bloomberg. Inflation. It's all the talk these days among investors because of what it could do to your portfolio, as Nancy Davis of Quadratic Capital explains.
Inflation is a risk to every investor portfolio because it reduces purchasing power.
And Treasury Secretary Janet Yellen took to the airwaves on CNN to disagree with our own Larry Summers about how long it will last. But while people are debating the size of the problem, investors are left to make sure they're protected against the downside, looking for what Bob Prince calls inflation hedge assets.
You want inflation hedge assets because it's very likely that the rise in interest rates will lag inflation and lag the economy. The Fed doesn't really want to get ahead of it.
Ranging from things like gold to things like cryptocurrency, according to Larry Summers.
Bitcoin has had some emergence as digital gold. The thing you want to hold if you're worried about inflation.
One asset that might get overlooked is farmland. Historically, farmland returns have outpaced inflation in a variety of market environments, providing returns more than double the inflation rate for decades. And right now, the farming sector is booming.
It's a really robust story, right? Net farm income is projected by the Department of Agriculture to be up 20% to a level of $113 billion, which is a level we haven't seen since 2013. So in aggregate, on average across the country, that's a really good story.
We welcome now to Wall Street Week one of those who is focused on farmland investing as a sensible hedge against inflation. Jose Minaya is the CEO of Nuveen, which manages over $1 trillion in assets. Welcome, Jose. It's great to have you here.
Thank you for having me, David.
So you really are introducing me to this whole idea about farmland as a hedge against inflation. Tell me how you came to it and how you think of it today.
You know, we came through it through our traditional portfolio construction process, right? We were looking for assets that brought attractive correlation benefits to our portfolio. We were looking to smooth out volatility. We're looking to kind of find a good hedge against inflation, and also looking at total returns that were more skewed towards income returns. And we found that in farmland, but what made farmland really attractive to us, I always say, is one of the best investment theses I've come across because it's as simple as people need to eat. Yet what we found was you have an inelastic demand supply, right? It's one that the populations are growing, the middle class is growing. It takes 10 pounds of grain to make 1 pound of protein. So as they're consuming more protein, that demand continues to be pushed and it accelerates. You look at the supply side, it's also inelastic because they're not making any more land. If anything, production is being strained by environmental factors. So when you combine that, it made for a perfect place where we can fit in our portfolio construction.
So give us a sense of the return from this sort of investment over the longer term, because I've seen some pretty staggering numbers.
And you know, and obviously, like many different investments, there are different risk-return profiles. But for us, typically, we're seeking, call it mid to high single-digit returns. If you say 8 to 10% returns, half of that is coming from income, the other half is coming from capital appreciation. And the lower return is because there's different risk profiles, right? We go to the areas that we're more protected against natural disaster issues or climate change. Water is a key factor in this asset class, and you can mitigate that risk by going to areas that have a better source of water. They're going to be more expensive. Your cap rates or returns are going to be lower. But again, we're not investing in farmland or really alternatives in general for an outsized return. We're really looking for where can we find some of that stable income with good protection of our principal, right? When I think about farmland, we're buying land that is producing an essential need for society into perpetuity. So that gives me really strong intrinsic value. So it's almost like owning a AAA bond, yet I'm getting a 4+ or so % coupon on that particular asset that has really been stable through the years from a volatility perspective.
Jose, compare and contrast a little bit this asset class from other alternatives on two different matrices. One of them is stability. You just said volatility. How does it compare in terms of volatility? And the other is, we're all talking about inflation right now and how we're going to protect against inflation. How does farmland do?
You know, well, farmland, again, how it compares to other asset classes today is that it's not as further along in terms of its access to capital markets, right? When you look at Sharpe ratios, for example, farmland really pops relative to another real asset like real estate. A lot of that has to do with liquidity and access to capital. If you look at real estate 50, 60 plus years ago, it had around a similar profile in terms of who were the owners of those assets. Today, you and I can go to talk to an advisor or a broker and get exposure to real estate. You can't do that in farmland as much. So that, again, that inefficiency kind of adds to the alpha and the excess returns that we can derive from that asset. And then ultimately, it's a commodity. So from an inflation perspective, that dynamic of inelastic demand, inelastic supply, right? As that stretches and commodity prices typically go up and follow inflation, it's proved to be a very, very strong hedge against inflation.
So why hasn't farmland historically had the same access to capital markets? I mean, what are the markets missing here? Where's the fail?
Well, look, I think you could have said the same thing around. It's just when these opportunities come to market and what is happening from a societal perspective, right? So today that demand is being stretched, right? We've seen productivity of agriculture go up about 70+% since the 60s, right? So if I think about, we're projected to have around, call it 10 billion people approximately by the year 2050. We also know that today, around 35% of the population consumes less than 2,500 calories a day. That's forecasted to go to 3% in the future. That is an immense stretch on the need and the demand to improve productivity. And it makes this asset class more attractive. So as individuals, when we went from just investing in stocks and bonds, then finding more alternatives like private equity, like real estate, like infrastructure, it is that need of where are the places you can put capital that continue to provide better diversification benefits for your portfolio.
You mentioned one aspect about liquidity. In general, we think you're giving up liquidity if you're going to make this investment. Is that right, or are there vehicles in which an investor could actually have somewhat more liquidity?
Yeah, it's interesting. I'm obviously somewhat biased because I grew up on the private side of investing, and I always view liquidity as an illusion, right? And what we found even in the global financial crisis, in other areas, your bonds trading at 20 cents on the dollar do not feel like liquidity to me. Yet we also understand that we love investing in illiquid assets because it adds to the excess returns that we can get. Our ability to diversify our portfolios, get access to these assets, we're willing to trade the liquidity for the stability and the excess returns that we get.
Let's talk about how the business of farmlands are likely to evolve in the coming years. First of all, talk about climate change. One of the things we hear from the people who are most concerned with the climate is farming is really contributing to some of the problem. We're putting carbon into the atmosphere. The mere tilling of soil, as I understand it, will generate some carbon, but certainly you have things like cattle and things. How is that going to evolve as we go forward? How are we going to meet some of our goals globally for the climate consistent with the need for farming that you describe?
Yeah, and I think, usually on the carbon side of things, livestock is kind of more of a bigger contributor to kind of the carbon footprint. On the farmland side, I think farmland actually could be a benefit of reducing carbon footprints. And you're seeing technology come into play today that is transforming the industry. You've got driverless tractors that are there. You have the ability where before you had to spray an entire field. Now you have technology that can identify the spots to kind of go in and say, okay, I'm going to spray here, but I don't have to spray in this other location. We ourselves use satellite technology and intellectual property that we can look from above and say, well, one, where are the areas, where do we see yields improving or worsening? How do we become more specific with how we deploy insecticides or how we deploy different soil amendments? And even now being able to use that technology and saying, what would happen to the productivity of this region or this farm if temperatures went up by 1 degree or went down by 2 degrees? We can forecast that now and mitigate these risks and go to the areas that we think there's going to be higher value in the future or areas that we think might be at risk in the future.
Exactly what I was going to ask about, because there's another way climate interacts with farmland, which is we read now there'll be areas of the world that have not been something you could raise crops on that will become. Siberia is something you hear about a lot. Other areas, including perhaps here in the United States, that will no longer be usable.
And we follow those trends. Now, the interesting thing is that, the amount of infrastructure that is in place to make agriculture work in the areas that it does today is in the trillions, right? You think about the Mississippi River, you think about barges, ports, storage, processing. So the first thing that'll happen is it'll impact values, right? Because commodity prices, if they're strained, because the weather's changing, commodity values will up. Yet if you go to Siberia and it becomes a tropical paradise, it would take trillions of dollars, if not hundreds of billions, to get the infrastructure in place and time to be able to make that area that you can grow a crop, but now you have to be able to transport that crop. You have to be able to process that crop. And that's why, again, when you think about demand supply, they're so inelastic, because making broad moves within agriculture takes a tremendous amount of time and capital.
There's an awful lot of international trade in agricultural products. How do you take that into account? I mean, we've just seen that within the last couple of years, actually, with respect to China and soybeans in Brazil and the United States.
Well, for us, look, one key tenet to our investment thesis and in our, I should say, our investment process, we only invest in the regions that are the major grain exporting regions around the world, right? So we don't want to be involved with food security, number one. We also want to be closer to the areas that we know are growing quicker. So if you think about the U.S., for example, it's in the mid-single digits, the amount of our disposable income that goes towards food. Other regions, that's 50, 60, 30, 40% of disposable income is going towards food. Now, what's meeting and lowering that number is increased productivity. It's kind of going in and going to these regions that we know are closer to places like Asia that have a faster growing middle class.
Jose Minaya, thank you so very much. He's Nuveen CEO here on Wall Street Week. Coming up, we wrap up the week once again with our special contributor, Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin, and we're delighted to welcome once again our special contributor to Wall Street Week. He is Larry Summers of Harvard. Larry, thanks for being back with us. Let's start with what happened actually on Thursday. Just as the president was leaving to go over to Europe, he announced what he called a framework for something on his Build Back Better plan. Not clear how that's going to develop, what's going to turn into law, but let's assume it was enacted just as it's proposed, described by the White House. What would it do in macroeconomic terms? What would it do to growth? What would it do to inflation?
I don't think the effects are likely to be large in the very short run, but I think over the medium term it'll be a positive for growth because it'll expand the capacity of the economy, and I think there might be some benefit in terms of inflation. I don't think it's likely to be large. I think there are a number of important investments there, including in the bipartisan infrastructure bill, which will come along with it. I think there are some movements to promote clean energy, which ultimately I think can help our economy. I think it's a very positive thing that there's a significant increase in revenue that matches the increases in expenditure. So I certainly hope that this bill will pass. It's far from perfect, but I think it's a real achievement and is in many ways one of the most significant pieces of economic legislation we've had. It might be the most significant between the two bills piece of economic legislation we've had in the 21st century so far.
So, Larry, you mentioned how it's going to get paid for, the proposals at least, on taxes, and you saw at the very end they backed off of the so-called billionaires tax, which is actually a proposed tax on the appreciation of assets held by people rather than income. They now have sort of a surcharge on multimillionaires, as they call them, as well as a minimum corporate tax of 15%. Is that, as a matter of tax policy, a more sensible way to go?
I thought the billionaires tax was not the right thing to do. I thought the mark-to-market capital gains aspect was impracticable, and I thought the general idea of targeting a few hundred people for a special tax was something that didn't fit with my sense of the right values. Much better to have a broader base tax. Frankly, David, what I think is disturbing is that in the way this bill is likely to pass, it's not completely clear yet, depending on what happens to state and local taxation, there will be a large number of people with incomes of, say, $8 or $9 million who are going to see their taxes go down. And I'm not sure that this was a time when people in the top 0.1% of the income distribution, top 100% of the income distribution should be getting tax cuts. And so I'm disappointed that in a bill that's passing only with Democratic support, we're not doing anything about top-rate taxpayers until they get above $10 million. We're not doing anything about capital gains. We're not doing anything about carried interest. We're not doing anything about so-called stepped-up basis and estate tax issues. I think it's an odd thing for there not to have been more taxation on people who can afford to pay it without going to the rather different step of singling out a few hundred people.
So, Larry, let's talk about the overall economy here. We got numbers out this week showing that growth was slowing as people expected, but it slowed a bit more than we thought in the third quarter in terms of GDP. At the same time, core PCE continues to move up. And we've talked about inflation a fair amount. You were certainly in the news this week because actually on Sunday, CNN played for Janet Yellen, Treasury Secretary. One of the things you said on Wall Street Week right here, she disagreed with it, and then you disagreed with her on Twitter. Take us into that debate that you're having right now with the Treasury Secretary.
Look, I have enormous respect for Secretary Yellen, and I hope her judgments about inflation prove to be correct. I have the view that we've got substantial risks right now. It seems to me that almost everyone is experiencing a shortage of something. Almost every employer is having trouble finding workers. Those seem to me to be the conditions for inflation to take a ratchet up from the 2% level we've been used to. And I think that's going to happen, and it's going to happen with an indefinite horizon unless somebody does something pretty strong to stop it, or unless we have some kind of financial accident. That's the position that I've been trying to make. I was glad to see Secretary Yellen recognize that certainly out to the second half of next year, so that's almost a year from now, 9 months, we're in agreement in expecting inflation well above 2%. I was very glad to see that. We'll see what happens after that. Certainly a lot can happen, both in terms of policy and in terms of the economy until then. But right now, I see a variety of things suggesting that inflation may accelerate, starting from the tremendous shortage of labor that we're dealing with, which is, I think, what held the economy back in terms of the GDP growth figures.
So let's talk about those two things, both how long it's going to last into 2022 and the shortage of labor, because we've had a lot of earnings out this week, and we hear from CEO after CEO about problems with the supply chain, and particularly on labor. In fact, we saw Amazon actually disappoint the markets because they say they're going to have to spend a lot of money to get the people they need to deliver things in Christmas. What is the importance of going into 2022, into the middle of 22, maybe even after that? How long does that affect the economy?
You know, we'll have to see. We'll have to see at what rate labor supply comes back. And if labor supply comes back, when it comes back, if it does, we'll have to see how much that adds to spending power. You know, if more people start working, then more people are going to be earning and more people are going to be spending. And so in terms of the supply-demand balance, it may not get us ahead by that large a margin. So my own view is to be quite concerned that we're ratcheting up to a new kind of level of wage expectations.
Larry, finally, as you know, we've got a G20 Summit going on in Rome this weekend, and then followed by the COP26 in Glasgow. What do you hope, what do you expect might come out of that in concrete terms on two fronts? One is the climate, but the other, one of the things they have to address is really vaccination and getting our arms around the pandemic globally.
I hope we're going to see commitments on funding for vaccines, commitments on some kind of governance structure so that it's better managed the next time, and so we're focused on preventing the next global pandemic. And I hope we're going to see substantial commitments where there's a meaningful prospect of enforcement on the climate front. I'm not optimistic right now that we're going to see as much progress as I think future historians will think we needed on either global health or vaccines. But let's see what happens. A lot can always happen in the course of these meetings.
So let me be very concrete for a moment. When we talk about trying to keep it down to 1.5 degrees centigrade, do they need to come out of COP26 with specific commitments about limiting the use of coal at some date in the future?
It would certainly be very helpful. Or they need to come out with some set of commitments on what they're going to get done in terms of being able to take carbon out of the atmosphere. We are not currently on a credible trajectory to anything like 1.5. I think it would be a minor miracle if coming out of COP, we were committed to such a trajectory and the sand is running through the hourglass.
Okay, well, we'll have to watch that. Thank you so much to Larry. It's always great to have you with us. It's Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, one more thought. A billionaire tax? A patriot tax? Who could object? That's next on Wall Street Week on Bloomberg. Finally, one more thought. $1 trillion just ain't what it used to be. The late senator from Illinois, Everett Dirksen, famously said, "A billion here, a billion there, pretty sure you're talking about real money." Well, at least some people remember that he said it. There's no real record that he did say that. But this week, we were talking about 1,000 times that billion, as Democrats struggled to get their spending package down under $2 trillion.
You hear these numbers, 3.5 trillion or 1.75 trillion? We pay for it all. It doesn't increase the deficit 1 single cent. So let's get to work.
And the key senator, Joe Manchin, pointed out that all of World War II and the Marshall Plan cost the United States only about $4.7 trillion in current dollars. And we've already blown way past that in the last year and a half before adding another 1.5.
We saved the world in World War II. We rebuilt Europe on today's dollars at 4.7. We've already spent 5.4. And we're about ready to spend a heck of a lot more.
But it wasn't just the government this week who was talking about trillions of dollars. Tesla blew past the $1 trillion market cap number, making Elon Musk a $250 trillionaire. It wasn't just the T word that connected Tesla with Congress this week. When lawmakers went looking for some way to pay for some of those new programs they want to adopt, they quickly focused on the very wealthy. People, yes, you guessed it, just like Elon Musk. At first, they came up with something called the billionaire's tax, which actually is not a tax on income at all, but a tax on the increased value of assets held by billionaires. That is something that made Republicans like Mitch McConnell apoplectic over the unfairness of it all.
Our Democratic colleagues and President Biden are behind closed doors dreaming up creative new ways to grab literally historic amounts of the American people's money.
But then again, Democrats like Sherrod Brown of Ohio said it would only be fair.
We've seen executive compensation explode upward. We've seen profits go up. Wages have been flat. And Congress has rarely been on the side of workers. This Congress, in these two bills, we're clearly on the side of workers into fixing that.
Democrats may have backed off of that so-called billionaire's tax, but they replaced it with a multimillionaire's surtax. Because in the end, them that's got shall get. But you may have to give some of it back. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.